Hello and welcome to the Finance Quarter. I'm Andrew Robertson. In 1992, when Paul Keating introduced compulsory superannuation, the aim was to provide adequate retirement incomes for all Australians. But now, nearly 20 years on, serious questions are being asked about whether the superannuation industry in its current form can actually deliver on that goal. And as the ABC's Stephen Long has discovered, a big issue is that system-wide returns are barely beating inflation.
It was Paul Keating's vision, build the savings to make workers secure in their retirement. But over the past dozen years, the returns from the superannuation system have been chipped away.
It's not just bad for people's pensions, it's an absolute economic travesty.
At the ABC, we've analysed numbers going back to 1997, and across the entire pot of money in the super system, the average yearly return has been just 3%. That's barely ahead of the inflation rate over that time, and a lot less than you would have got for cash in the bank. Over that period, the size of the pot has almost quadrupled, but most of the increase, the vast bulk, has come from contributions, our money going in, not the money making money. There's a host of factors behind those poor system-wide returns. Volatile markets, millions of lost or inactive super accounts being eroded by fees, and the sizable cut being chipped out of super all the way down the line.
Quite simply, almost $47–48 million a day coming out of our superannuation accounts to pay suppliers for managing that money.
Is that justified?
I don't think so, no.
Fees paid to financial planners for promoting super schemes have been in the spotlight, but there's less attention on those who get paid the biggest money, the investment managers. They get a percentage cut of our super regardless of performance, so the bigger the pot, the more they get.
No one's willing to push the boundaries and say we need to change the way investment managers are paid.
Fees are one super-sized issue. Another, the massive tax breaks to encourage people to put money into super, which overwhelmingly benefit the wealthy.
Well, the cost of superannuation tax concessions in total in Australia is about $26 billion. That's almost as much as the cost of the age pension itself.
I have to ask the question, why would we spend more on the fees and charges and subsidies to super than it costs to run our current pension system?
The review of the super system the government commissioned should demolish some of these problems, but not all.
Stephen Long's research paints a picture of a superannuation industry that falls well short of what it's meant to be. And if that's true, the people who suffer in retirement are ordinary Australians like you and me. Well, to get some answers, I've come to the offices of the Association of Superannuation Funds of Australia to speak with its Chief Executive, Pauline Vamos. Pauline Vamos, system-wide annual returns of only 3% over the last 12 years. That would imply that superannuation is struggling to do the job that it was set up to do.
Look, we disagree with that. When you look at the investment returns that the superannuation industry has provided to the average Australian, to the average fund member out there, we're looking at least over the last 13 years, for example, at least 4.4% in returns. Way ahead of inflation, way ahead of what you would have got in a bank account.
The issue is how much money people have in their hand, and APRA measures the whole pot of money, the 1.4 trillion or whatever it is, and that's the money that people have in their hands.
You are right. The important figure is what members actually get in their accounts. When you look at the investment returns, the level of risk, the insurance services and other services they may have paid for. Now, the APRA figures, yes, they take a total figure of the whole industry, but those figures are measuring expenses, they're measuring revenues, but they're not about measuring investment performance. And that's why it's important, and they say that in their documents. These are not to be used for public purposes, they're not to be used for measuring investment returns. They are important figures because they add to the transparency of the industry.
Fees, of course, erode super earnings, and in fact in their last research, Super Ratings referred to the fact that fees had taken balances down considerably. How can percentage of funds under management be justified?
Fees, when you look at the fees across the Australian superannuation system, They range from anywhere from about 0.56% to 3%. The average is 1.2 to 1.4. That includes administration and investment fees. When you compare that average to other pension systems across the world, Deloitte research tells us that we hold up pretty well.
The reality is, though, that the cost of managing funds doesn't go up in proportion to the increase in the fund balance.
Many funds, as those funds have increased, the percentage or the ratio of the fee compared to funds under the management has reduced. And again, that's what the Deloitte research found for the Cooper research. Larger funds were on average paying less overall in their investment fees.
Do you accept, though, that the debate about fees and things like super returns puts out a perception, rightly or wrongly, that the superannuation industry is set up to benefit the people who work in it more than the people who have their money invested in it?
I think the debate about fees, the debate about returns is very important. But the whole industry is focused on providing value for fund members. Now, there is no doubt that the industry is of the size it is because of the compulsory nature of the system, but I would not agree at all that the system is not built and run in the best interest of fund members. Can it be improved? Yes. Can we get greater efficiency? Yes. Should we have certainty over regulation? Yes. Can we reduce some of the regulation? Yes. Should we be easier to do business with? Absolutely. Could we be more transparent? Yes. And that's what we are going to be doing over the next 2 to 3 years.
Well, Pauline Varmos, there's a lot to think about there. Thank you for your time.
Pleasure. Thank you.
Pauline Varmos, of course, presents the view from inside the superannuation industry. A man who studied the sector closely from the outside and who you saw in Stephen Long's report is Dr. Michael Rafferty from the Workplace Research Centre here at the University of Sydney. Mike, is the superannuation industry doing what it was set up to do?
Well, look, there's been a very rosy story about superannuation, which was going to be building a savings pool that would supplement the age pension. And that rosy story had a lot of boosting during the big equities boom, but the GFC's made a few things quite stark. One of those things is that the risks associated with superannuation can be quite considerable. So most people are still going to be calling on the age pension, and the superannuation system is sort of, in a way, a sort of a buffer. But it's not. The increasing story is that you're on your own to fund your own retirement, and superannuation, therefore, is really important. Whether or not it's delivering as it was promised is an open question.
Well, just leaving the pension out of it for a minute, how can we make the superannuation system totally fund people's retirements? I mean, is that possible?
Basically, no. You would need to be looking at much higher contributions, and of course that means that that's going to take away from people's current ability to pay the bills and pay for things like housing. One of the paradoxes, of course, is that one of the most important predictors of post-retirement poverty is the fact that you don't own your own home. Now, one of the challenges then is how do people pay for their own mortgages when we're going to move to perhaps 12% of your income coming out in super contributions?
Should you pay off your mortgage first and then worry about super, or should it be the focus on super for your whole working life?
Well, I think the clear message is that all the research points to the fact that owning your own home is a great buffer against old age poverty.
So your advice would be pay off your home and then pour as much as you can into super?
Well, I'm not a financial advisor, but I think that we do know that superannuation isn't going to be enough to, for most people. They're still going to rely on the pension. So in that case, you're better off to own your own home.
How do we make the superannuation system do what it was set up to do, and that's provide total retirement incomes?
Well, there's a lot of things that would have to happen. I think the Cooper Review did some great things by focusing on the amount of fees that get taken out of superannuation, something like $40 million a day. And a lot of those fees are quite excessive. I mean, we know that the fund management industry is very expensive, and it's very difficult to discipline fund managers when they're a part of a banking oligopoly. I think we need to sort of there's three options really for people. We either have fee caps, and that is where we stop funds from charging more than, say, 1% of fees on assets. We change the whole mix of fees. We have arm's length contracting. So there's a range of things we can do. I think Cooper focused on fees, but the recommendations simply didn't go far enough.
Is part of the problem that a lot of superannuation funds are set up with their first priority to provide good returns for shareholders, and good superannuation fund balances are a secondary priority?
I think this is a problem. While the industry itself is very expensive, there are some funds that are low cost that do have arm's length contracting and do deliver pretty good returns. So while the industry itself has got some serious problems, there are business models that we know work. Not-for-profit funds, arm's length contracting, and having representative trustees on fund boards does make a difference. And I guess it's a bit disappointing that Cooper didn't say, look, the privilege of managing people's compulsory savings should only go to those funds that can demonstrate that they do it as well as possible.
Well, just finally, for somebody watching this program who might be now thinking my super's not going to work for me, what are their options?
Well, I think the options are, first of all, that here's a problem. First of all, we're a lot of individuals, and it's very hard for anybody individually to sort of to work out the risks involved, the timing of their investment, when they're going to retire and in what sort of state they're going to be. So I think individually is very, very difficult. We all want people to be more engaged, but you're conscripted into the system. I think the answer has to be that trade unions and political parties have to actually engage people in a debate about what we want from a retirement system.
A lot to think about there. Dr. Michael Rafferty, thank you for your time.
Thanks.
Now, we don't want anybody heading off down the wrong path, so just a reminder that the Finance Quarter is general advice only. Before acting on anything you hear on the program, you need to speak to a qualified expert who knows your financial circumstances. The lesson from today's edition of the Finance Quarter is that for the best possible retirement outcome, you need to engage with your super as early as you can. Thank you for watching, and thank you too to those people who've sent in questions and suggestions for topics we can cover. If you'd like to contribute, our email address is thefinancequarter@your.abc.net.au. We'll see you next time on the Finance Quarter.